Welcome back. Now a look at where markets ended the week of mixed earnings reports for the third quarter. Investors are awaiting the biggest tech names in the world reporting in the week ahead. Joining me now to get ahead of it is Piper Sandler's chief investment strategist, Michael Kantrowitz. Michael, great to see you.
Good to see you, too.
Thank you so much for being here. So the earnings news so far, how would you assess it, and what are you expecting from next week when we get names like Microsoft, Meta, Amazon, Apple, all reporting in the week ahead?
Yeah. So most of this year, S&P earnings estimates have remained pretty resilient. In fact, from the beginning of the year through today, earnings estimates for large caps are up about 10%. And they've held in, the estimates for next year have held in really strongly. So that tells you that companies are beating and guidance remains pretty strong. But as you go down in capitalization, even within the tech sector, it's a very different story. Estimates for small caps have been falling all year and are expected to actually be below last year's earnings. So we're expecting more of the same in that bifurcation. The larger companies with economies of scale that have better balance sheets and certainly more growthy will continue to do well in this economy. And those smaller companies that are most negatively impacted by higher rates, high prices, labor costs are going to continue to struggle, especially as we, in the last few weeks, have seen interest rates back up.
Yeah, I mean, real interest rates, the 10-year, all the way up to 4.2% this week. I'm wondering why rates are moving up in real time, even as the Federal Reserve said that they're cutting rates further this year.
Well, I think it's two things. One thing I can certainly explain and quantify, the data has been better in the U.S. economy in the last month and a half. We've seen particularly better employment data. The unemployment rate has come down for 2 months. Unemployment claims have come down. We had a massive GDP revision to the upside. So when you look at the economic surprises, they do track 10-year interest rates pretty well, or I should say yields track the data pretty well. So that data has clearly improved in the last month since the Fed has cut. And then I think the market's also beginning to price in, or has been pricing in, a greater likelihood of a Trump win. And I think a lot of investors are seeing that as a backdrop where yields are going to be higher.
And I know you did a report on the Trump portfolio versus the Kamala Harris portfolio, you and your colleague, Andy LaPerriere.
Yep.
And I want to get your take on that Trump trade that you're seeing play out on Wall Street and whether or not it's too late to get in, particularly headed into next week where we have all these major earnings coming out. I mean, you've got Amazon, Apple, Microsoft. Is it once again going to be all about AI?
I think so. I mean, certainly we've seen that in the semiconductor space and with their earnings reports in the last few weeks. I think, when you look at the race, the odds are pretty, the race looks very tight. So I don't think investors are taking big bets in the market, and I think are ultimately going to have to react to the outcome of the election. But again, with the data improving, I think that's driving a big part of it. But yeah, I think for tech, one of the areas in large caps that continues to propel the overall indices earnings, people will be very focused on the AI story.
So tell me about how you and your colleagues have put together the portfolio to own right now based on this election and what you're betting in terms of Trump versus Harris.
Yeah, so Andy's work is definitely more idiosyncratic, looking at different sectors where the policy differences are more clear, like in EV and energy. But then, we have to also consider just the backdrop in the U.S. and global economy. So one of the factors for those that are looking to pick stocks that has done exceptionally well pretty consistently across elections is companies that are value. So we did a report highlighting that after the last 6 elections, value factors and value strategies have done well after each one.
Regardless of
the outcome. And perhaps maybe that is, if the incumbent president wins, people, assuming maybe that's a reflection of a good economy that's been good, so people can kind of take more risk and buy value companies. Or if the incumbent loses, then there's new hope for a new leader, and people again take on more risk and buy value companies. So perhaps that's the explanation. So we've been highlighting stocks that have really high free cash flow yields. So companies that are cheap, but cheap on a cash flow basis. And so that's been a strategy that I think investors are already pricing in right now. And will continue to do so. And I think what's compounding that outperformance in those types of groups and names is this bifurcated earnings backdrop we have in general.
And with value stocks, you also potentially get the possibility of a dividend payout.
Yes.
Is that right?
Yeah.
Value names usually pay dividends.
Yeah,
I'm thinking about utilities, I'm thinking about oil companies, and they're sizable dividends.
Absolutely, and as the view of interest rates, certainly on the shorter term money market rates, are going to be coming down as the Fed continues to cut rates, even if it's slower than the market previously thought, stocks with higher dividend yields are likely to become more attractive. And utilities is a sector that's done really well this year. And the bulk of that outperformance has actually come as interest rates and Fed rate cut expectations have moved towards lower levels.
You still think the Fed's going to cut further this year, do you?
Yeah. I don't think anything's radically changed. I don't think we'll get another 50 basis point rate cut, but I think the market's still pricing in greater odds of more than one cut. So I think that's reasonable. And as always, the Fed will be data dependent.
Yeah. All right. We'll leave it there. Michael, great to get your insights.